Welcome to Quick Invest Brief. Many people wonder, do I truly need a financial advisor? With accessible, low-cost passive investing, is paying a fee worth it? This crucial question depends on your financial situation, knowledge, and goals. Today, we're cutting through the confusion to help you decide. Let's find out. First, consider when you might not need an advisor. If your finances are straightforward, stable job, manageable debt, a solid emergency fund, and you consistently invest in broad, low-cost index funds or ETFs within tax-advantaged accounts like an ISA or 401k IRA, you might manage independently. For those committed to a passive buy-and-hold strategy, an advisor's active management becomes less relevant. If you enjoy learning about personal finance, are disciplined in budgeting and rebalancing, and stay calm during market volatility, you might not require one. Also, with smaller investable assets, percentage-based advisor fees can disproportionately impact your returns, making self-management more cost-effective. Now, let's explore scenarios where you might significantly benefit from a financial advisor. For complex financial situations and major life transitions, such as marriage, divorce, inheriting substantial assets, or career changes, objective guidance is invaluable. If you have a high net worth, managing intricate tax situations, sophisticated estate planning, or diverse income streams, professional advice can help consolidate and optimize everything efficiently. Another critical time is for retirement withdrawal strategies, especially for early retirees. Drawing from various accounts like taxable, Roth, or traditional IRAs, ISAs, or SIPs involves massive long-term tax implications. A skilled advisor can craft a tax-efficient withdrawal strategy to minimize your tax bill over decades and manage sequence of returns risk during market downturns. If you engage in active or highly complex investing, like individual stock picking or private equity, a specialized advisor can provide insights, risk management, and diversification strategies beyond basic passive investing. Be cautious though. Active management often means higher fees and doesn't always consistently outperform passive strategies. One underrated benefit is behavioral coaching and emotional discipline. During market volatility, fear and greed can lead to costly, irrational decisions like panic selling. A good advisor acts as a steady hand, preventing emotional mistakes and helping you stick to your long-term plan. This guidance alone can often justify their fee. Advisors also assist with broader, integrated financial planning goals like estate planning, tax optimization, and insurance needs, ensuring your financial picture is holistic. It's vital to understand the types of advisors and their fee structures. There are several common ways advisors charge. Fee-only fiduciaries charge exclusively for their advice and are legally bound to act in your best interest. Their fees might be a percentage of assets under management, AUM, typically 0.5 to 1.5% annually, hourly fees for time spent, or flat fees for a specific plan or service. In contrast, commission-based advisors earn money by selling specific financial products, which can create conflicts of interest. While less common for typical individual investors, performance-based fees exist for some specialized funds or higher net worth clients, where the advisor earns a fee only if your portfolio achieves certain returns. Lastly, some advisors use hybrid models, combining elements of these structures. Understanding their precise fee structure is paramount before engaging any advisor. Ultimately, the decision to hire a financial advisor isn't simply about avoiding fees. It's about assessing the comprehensive value they provide relative to your specific needs and what you can realistically manage yourself. For those with complex situations, substantial assets, or who genuinely lack the time, in-depth knowledge, or emotional discipline, a good fee-only fiduciary advisor can be an invaluable asset, potentially saving you more in taxes and preventing costly mistakes. For others, particularly passive investors in early accumulation, diligent self-management might be the more cost-effective path. What are your thoughts on financial advisors? Do you use one, or do you manage your own investments? Share your experiences in the comments below. If you found this brief helpful, please hit that like button and share it with someone considering a financial advisor. And for more powerful insights, briefly told, subscribe to Quick Invest Brief now.